Hello and welcome to the AgriFocus podcast from Agriland that takes a closer look at the issues that matter most to farmers across the country. Now, it's never not a busy time when it comes to farming, but with calving season in full swing, milk prices fluctuating and farmers under pressure from every angle, including the weather, you really don't need anything more to think about this week. But if you're not making money, then what's it all for? I'm Francess McDonnell, and in this episode, I'm joined by Patrick Gowing Dairy Specialist at Teagasc, and he's going to look at the real challenges facing dairy farmers right now and, more importantly, what to do about them. So Patrick, tell us about the rule of thumb you apply when it comes to spring calving systems.
Thank you. Yeah, just generally, I suppose, when we're looking at it and we go back through it, I use that 60-40 rule as to explain to farmers, like, and if you're looking at your costs and you're trying to save costs, 60% of your costs generally come in the first half of the year, and then 40% of your output, and it flips to the second half of the year. So if we are talking about saving costs, looking at it in September, the year is nearly gone, and it's very limited what we can do. If we want to change our cost structure to look at, we have to start now and move on from here to have any impact for the year. So it's just to make farmers aware that if you want to move, you have to move now.
So the message really is decisions made in February will really define profits by the time it comes around to December.
Yeah, yeah. February, the spring is the key. In any type of farming, I suppose the spring. If we get the spring right, we generally have a good year. Unfortunately, this year, like the weather has been poor up to now. But that doesn't mean that we can't when the things it does improve, and it will improve. It always does this time of year. That we start reacting and get back on track. I think is the key thing. Like that we don't just sit in the depression. Milk price is bad, weather is bad, and nothing we can do. There's always something you can do.
It is a difficult sort of start, though, isn't it, the calving season this year? Because you say we've had this kind of worry about where milk prices are going. We've seen that with the trend with co-ops setting their milk price, and obviously, as you've said, the weather's been terrible. So, do you find that farmers are proactive or reactive when it comes to making these kind of decisions?
I think there's a couple of things there. Generally, farmers are very reactive in a situation like we're in at the moment. It's bad weather. They're doing their best to get cows out. It is tricky. It's very tricky. But where they can, they're going. They obviously have to feed a little bit more, associated with having cows in more than they'd like. Where I find sometimes where they're not as reactive is when the good times come, as we said already. So if the weather improves and the dry weather, is we tend not to react as quick, and maybe to make back some of that cost that we had. Like, so if things are good, we need to readjust fairly fast. So for a lot of farmers, I suppose, is they react and then very quick because they have to, and then maybe they're a bit slow to react on the way out. I think it's a natural thing this time of year too, because you're busy, you fall into a rhythm, and you sort of get stuck in your ways, and that happens in every walk of life, I think. But in generally, when you're busy like that, you just sort of default back to what you've done the year previous. And I suppose we have to look at again, like if what you've done the year previous maybe wasn't exactly the right place to be, maybe now we need to look at it and move forward. So yes, they react, but they can be slow. And I'd always say to like last year was a very good spring, very good grass spring, weather spring, but there was no adjustment from a feeding point of view. So if we feed more in the bad weather, then we should feed less in the good weather, basically.
Yeah, and it is a time of year where people get tired very quickly, aren't they? Because they're going, really with calving, you don't really get a break. But where should farmers start if they want to start thinking about, right, what do I need to do here?
First step to me, and it's look, yeah, I agree. You're busy. It's heads down. You can likes of me coming on telling you to look at costs, and there's calves feet out the whole time, and there's calves to be trained, and there's all other things to be done. It can be a bit annoying, but in reality, you have to start and look at. And I suppose the first place is the profit monitor. If you have it done, or there's still time to do it, it can be done at any time of the year. That's a benchmarking report that Teagasc have that we look at to see where your cost structure is, how the farm is set up, and obviously you're benchmarked against your peers. Within your county, your group, or the country, it doesn't matter. And I suppose that's the start point. And like what we've seen over the last number of years is like that the costs have increased. So you're probably running since 2022, sort of in that range. A lot of farms between 37, 38 cent a litre on average. And I think the average is very misleading because what is an average to you if you're higher than the average. So is where you are compared to that. And what we have seen is as costs have got higher, the range from high and low has widened as well. So there's a lot of farmers there that are able to produce still at 32, 33, 34 cent a litre, and then there's people gone over 40 cent a litre. So the first thing is, where are you on that against the average? And the next thing then is, obviously, if you identify an issue, is to react to it, find what the issue is, and then start reacting. Sort of a Roy Keane quote there: if you do the same old thing, you'll get the same old results. Like, so.
And whenever we talk about cost structures, that's sometimes an area that farmers want to shield away from, isn't it, a bit?
Yeah, I suppose maybe it's historical and not sharing information. To me, the profit monitor is not it's not a league table as such. It's for yourself. It's to see, can you make more money in your own business, and that's what we're here for: to make money, make a margin, nice way of life from a farming point of view. But we have to get a return from it. And there's a lot of stuff going on there at the moment too, like with there's nitrates, compliance issues. There's a lot of decisions farmers have to make in which direction they need to go in to best get their business best lined up going forward. And I think, starting with where you are from your business point of view and looking at the figures and moving it through, the other thing we would notice, particularly since 2021, is like farmers are running large businesses because the nature of the milk price rises. The big turnover on these farms. And big turnover is great, but also the cost came with it. So we have to make sure that we're not just moving money through the business and we're trying to retain some of it. So the profit monitor, and from that profit monitor, you start doing your budgets, whether it be a cash flow budgets, meal budgets. There's something has to give. If you're on the wrong side of that average, as we've mentioned, what's going to happen? What's going to change? And I suppose what we would be asking for farmers is, you have to everything that comes into the farm has to be justified, and you have to get a return from it. And if you can stand over it and you're happy with it, that's fine. There's no issue. That's the decision you made as a manager. But if you're not getting the return, or it's not working, maybe look at it. And is there an alternative way of doing it, or can we do something different? And that's all we're asking, is justify everything you're doing on your farm. Milk price dropped substantially, and we would go back and look at it from 15 to 16, milk price dropped about 18 cent a litre. And it took about a year and a half. It nearly dropped the equivalent in 3 months this year. So for whatever business you're in, you cannot handle that rate of change of milk price. So the only way to handle it is to be set up to the low price, because it's moving up and down so fast now. It's very hard to be setting yourself up for the high price.
So if a farmer's seeing that costs are high, should they be asking themselves, why is that high cost there?
So if you're above cost and any cost, if you're not getting return, should should it be there, and can I do something different? And can you justify it? And what we would have seen that again, and if we look at the last number of years from 22 to 25, 22 was obviously a good year, it was the record year. 23 was a bad year, probably similar to what's happening now. If you look at 22, we got the good price. 23 started with it was probably the second half of the year. The weather turned on us, milk price dropped. 24 again was a bad spring, average profitability year. 25 was a good year, and 26 again, we're starting off in a bad year and the milk price is lower. And all we'd say with across all them things is, if you're looking at the trend of good years to bad years, so 22 was good and 25 was good, 23, 24 is average, the other 2 years are below average. It's average over 5 years. So setting a cost up for the 1 year of the good year, that's fine once you react into the bad year, and we tend not to, tends to get locked into the system. So if it's not paying and it's driving up your cost structure, look at alternatives. So whether that's you're feeding too much, maybe it's a stocking rate issue, maybe it's you're not growing enough grass. If you're not growing enough grass, is that a reseeding issue, or is it a soil fertility issue? But it has to be corrected for, otherwise the cost is going to stay there.
And let's just move to what we could call the €50,000 question, because with milk forecasts under pressure, that could have a really detrimental effect for some farms in the bottom line.
As I said already, the drop in the rate and the speed of drop in the markets caught everyone on the hop into the back end of last year, and we're starting out lower this year. The key question is, when have we hit the bottom? And now some of the markets look to have turned. The auctions are up. little bit more positivity maybe there than there was even a month or 6 weeks ago. And again, that just shows how volatile the whole market is, and again, why we have to set ourselves up. If we do look into 2026 and what we can do, the beef trade or the calf trade and the cull cow price have been strong over the last 2 years, and that's going to have a good impact on farmers from their cash flow point of view in the first half of the year. We've modelled out some cash flows there, based on, we sort of have this standard 115 cow herd that we use to model out cash flows. And again, the extra value there for the calves above what we would have seen in 2023 and for the cows will have an impact. And then it'll depend on when we hit the bottom and how quick the return is. But again, we're going to find that pinch point in the spring part of the year, regardless of that. So we have to look at the cost then again. Again, when the weather comes, we get back into the feeding. If you are feeding, do you know what you're feeding, how much you're feeding within the year? Is it efficient? We would have done with a lot of the profit monitor groups a metric around kilograms of imported dry matter divided by your kilograms milk solids produced, and it gives you an efficiency factor. And if as the figure goes higher, it becomes inefficient. So it's a very quick test to your business over last year to see what you were doing. Was it right? Are we getting the return? If you weren't getting the return, then you need to look at it. So there's a lot of things there that we can start doing. So some of that 50,000 will be brought back a little bit with stock sales, and then we need to go find more of it through our cost savings ourselves. So again, look, if you're at 34 cent a litre, you're probably thereabouts. There's small changes you can make. If you're at 40, 42, 43 cent a litre cost reduction, there's scope there you can do, looking at your feed budgets, but also looking at all other costs in the farm. And when we went back and looked at this in 2023, I would have assumed that, the cost of production has gone up. The variance between one farmer to the other shouldn't be that much on all other costs. For example, everyone has to make silage, everyone vaccinates their cows and so forth on. But in reality, when we looked at it, there was a massive range within each cost from farmers. And that's where the whole bill of quantities came out, where we said, well, okay, why is there such a range? And what should the actual figure be? So again, we model out a scenario for farmers using the bill of quantities, and we update it annually, where we put basic Teagasc best practice protocols onto this farm. Pádraig O'Connor in Teagasc and Grange goes out, and we actually have a menu of the number of items you have to buy into the farm each year, down to boxes of gloves, right down to fine detail of exactly what needs to be brought into the farm, and we cost it out. And what we can use there for farmers, so say for example, if you're high in the veterinary, you can then go back and look and say, well, right, I'm high on my veterinary. The average on the bill of quantities is €110 per livestock unit. So if you're running, say, 170, there's €60 a cow differential. So why is that? And you actually go down on the items, maybe it's vet call-outs. So for example, we'd seen in some farms, the bill of quantities would suggest there'd be 5 vet call-outs per 100 cows. Some people run higher than that. What was the issue? Sometimes you can have a bad year from an animal health point of view. If it's a one-off, no issue. If it's happened every year, there's something going on. I know on a farm I looked at, it was actually a milk fever issue, that the vet was out a lot of times with milk fever. And that raises bigger questions around, well, why is there so much milk fever? And there's other things we can do. So it's getting this, instead of just accepting the cost, is making sure the cost is right and bringing it back through, and do that for every cost. And about half the differential in the high and low profit farms in a poor year, a poor milk price year, is on cost control. So it's there. And the other thing I would like to say is, like, in a good year, it's about 30%. So we can't ignore cost control in any year, because it's going to be a significant part of your business no matter what you do.
And whenever you look at those, it's the kind of tiny details, isn't it, that you're drilling down to there, because you're sort of saying the farmers know how much meal per cow they're paying when they're looking at concentrates, when they're looking at fat bills. It is the tiny detail, isn't it, that pays off at the end.
It is, yeah. And again, you mentioned it, you're 100% right there, that the 50,000 or whatever it turns out to be down in turnover, you can't just accept it. We have to react, and we mightn't get it all, but we get as much as we can. And again, the bill of quantities down. We know it sometimes when we looked at it from 22 to 23, it was around ESB and people not changing their ESB suppliers and paying above the odds for on the day rate or night rate on electricity. small things. That'll be 1,000, 1,500 you save, but another 1,500 back on that 50,000 you're talking about. Similarly, then on meal, I think the budgets are there is no budget, and we need to maybe set it up at the start of the year. How much are we planning on feeding? Times like we are at the moment, you'll feed more, but maybe there'll be periods at the later on in the year where you can make back some of the difference. And again, you can only sort of it's like all these things. If you monitor it and you budget it out, you have a chance. If you're just going day to day, it tends to just roll one day into the next, and there'll be no significant change. And we need to get this, like, what we need to get is for a bad year not to be a bad year anymore. Like, we're talking about people's livelihoods. Like, we have to make money every year because there's kids to be fed, house to be run, people to go to college or wherever it is. So accepting a year that you don't make any money, or sort of, if your business is on a high cost structure and it's taken the money from the good year to get over the bad year, in reality, over time, then you don't have any money as such on average. And that's not the place you need to be long term. You need to be in a situation that the farm covers itself in every year, and in the good years, it accumulates cash. And we need to look at that going forward, to make sure we're right. And that's where I would see some people. There's the one-off question that we have at the moment is how do we react to that 50,000 of a drop in turnover on average? But the other thing is the longer term stuff is, why do we need to be reacting to the bad years? We know the market is turbulent at best. We need to be setting our businesses up to for the market as it stands, and make longer term adjustments. Like, some of the best farmers that I would get the opportunity to go out at, they don't react to a bad year because the system is set up, the cost structure is good, and they know they can take it. But the key question is actually what they do in a good year. They also don't do anything. In a good year, they don't chase it, they don't do anything, they keep the system the same because they're in a very profitable system as it is. And that comes back to one of your original questions around being reactive or not being reactive. Is chasing a good year, knowing a bad year is coming, may not be the best option because the markets are not allowing us to do that. And I would have said this to a lot of
Yeah,
groups.
it's too volatile,
It's
isn't
too
it, at the
volatile,
moment,
yeah. And would have
really?
said it. I said it at the dairy conference as well. I think, if you had if you look at a cycle over 10 years, and you had, say, two bad years in 10, so that means you're going to have three good years on average with a bad year, followed by three good years, and then into a bad year again. There's enough time. You have three good years to accumulate cash that will more than get over the bad year, and then you're subsequently followed by three good years again. So you could argue in that type of a market, which is a lot more stable, you could maybe chase it a bit if you wanted to. But the market at the moment, as we already said, up, down, up, down, up, down. We don't have enough time in between to react, so we just have to set ourselves up for the low year. And the other question I would say, and like a lot of people, we haven't put two good years together as such. But the more important thing is we haven't put two bad years together, and that's a bigger concern. So the hope, and hopefully the markets have turned, as we said. But I'd often say to farmers, if you go back to June 24. So if you follow that through 23, the milk price dropped. It was low through the spring of 24. The weather was bad, and it's a simple test. Look at your current account. Look at how you were on the 1st of June 2024, and if you were under pressure then, you were saved by the weather improved and the milk markets bounced. And I would ask the question, what if it happened, or what if that had prolonged for 6 or 7 months more? We would have been in a serious situation. That's not a place we need family farms to be. If you found yourself tight back then, you need to look at what you're doing overall to see, am I on the right road, and then make the reactions.
Yeah. So we all know milk price is very volatile. We know that Irish farmers can't really dictate international markets. We know that for a fact. But what we can do is insulate against some of the downward trends.
Cost control in every year. Went a little bit lax maybe when there was a couple of reasonable good years in a row, and that's human nature, I suppose, a small bit too. But we just have to get back focused on it as well. Obviously from breeding, as well, you'd see that insulated against, obviously, your higher fat and proteins, get your bonuses above the base. That's critically important now, and you can see how fast the thing is that you're insulating yourselves, and some people are a long way down that road, and you can really see it in their figures, that they're delivering high value milk, and it's insulating them as well. Focusing on the basics, get back to the basics, grow the grass, give that grass to your cows of high quality. Don't overly stock because that'll drive up your costs because you're going to have to import the feed. So it's about just checking the system, and the system you're in, is the right place that's sustainable long term. And what you're doing there is we've got a good. I think if you go back to the quota time, we were told we were going to get a lot of volatility in milk price, and we did a small bit, but it wasn't. I think we're actually getting it now. The rate of change, the speed of change is nearly what they promised us in 2015, and we're getting it now. And I'd love to be coming onto the podcast here and saying to you, like, look, markets are going to be good for the next 10 years and rock on. It'd be a lot easier call for me to do. But we just have to, and we can wish and we can hope, but we have to play with the reality that's there.
Yeah, I think whenever we've spoken to some analysts recently from Rabobank, they've been saying second half should probably see a bit of an upturn. But even they're sort of talking about where demand's coming from. Is China going to continue to sort of drive some demand, and what's happening really across global markets too? So, as you say, the volatility is there. But if you are a dairy farmer and you feel that you're not really in the right place where you should be today, what's the top 3 things that you would recommend to them?
As I said already, profit monitor. If you're not happy, obviously, look, in the next month you're probably going to be busy. But contact, whether it be your accountant, your independent advisor, or your Teagasc advisor, don't just put your head down and keep working at it. Take the help. It's one-to-one with your advisor or your accountant. Look at where you are. Look at your business, and start reacting. So starting that with a profit monitor or some sort of benchmarking type thing. React to the figures, and that's again, a lot of farmers do generate a huge amount of information on their farms, and do we use that data to best serve the farm then again? So if there's something identified within that discussion with your advisor, react to it and make the changes and set your business forward. Budgeting then, from that meeting, set budgets, clear targets to what you want to hope to achieve. Obviously there's the benefit to a budget is the budget's always wrong because things change. So the budget it has to be a living document. So if things change, you update. I suppose that's like I've done. I won't say how long I'm in Teagasc now, but I've done a lot of budgets, and every one of them is wrong. But because no one ever updated them, you have to update them and keep working through it, and make it back, and then get back to the basics. Keep the simple system. Grass budgeting, good quality grass. No matter what way we look at it, we're in an energy business as such. We put energy into cows and take milk out of them, which is energy. So it's all to do with energy, and how we feed our cows and how we do it will have the biggest impact on our cost structure, no matter what way we twist it. And grass is and will be the cheapest form of feed, and maximizing the amount of grass that we can get into our cows. When we use a figure called net pasture, which is basically the amount of homegrown feed, which is grazed grass plus homegrown silage that you get through your cows. If you maximize that, you will deliver higher gross output and have a lower cost and be more profitable. And again, we see massive ranges within that across farms, and that's about going back to having the right grass in front of the cows, giving them plenty of it, and good quality silage. Which is the unfortunate thing with all this is this has been out for the last God knows how many years, but it shouldn't change year to year. If grass was important 3 or 4 years ago, there'd be no reason. There's nothing fundamentally that's changed in the market to say it's not important today, and in fact, it's more important. And getting that net pasture figure up, it would have a massive impact on your business. The average is about 4 ton of kilograms of dry matter fed down the cows, and obviously if you multiply that out by your stock rate, you'll get your grass utilized per hectare, which obviously one's a function of the other. Top farmers will be doing 4 7s to 5 ton, getting a huge amount of high quality homegrown fodder across into their cows, and that's having a massive impact on their profitability. And it's a very simple fix.
So some great advice there, but maybe not what everyone wants to hear at this time of year, but definitely something you should be thinking about. Our thanks to Patrick for joining us and to you for listening. And please don't forget to rate and review this AgriFocus podcast on Spotify, Apple Podcasts, or wherever you get your podcasts. Goodbye.